The bond market is the best reflection of what's going on in the world. It is the barometer for every politician, for every central bank. It really informs us every day where the mood of the global economy. And that I believe the bond market is indicating that inflation may be higher than we think.
So for more, let's bring in Kevin Simpson, founder and CEO of Capital Wealth Planning. Kevin, good morning. I want to get you to react to those Larry Fink comments right there. The tail end, I want to make sure you caught it. He said that the bond market may be signaling that inflation is higher than we actually think.
Well, we know that the bond market is bigger and smarter than the stock market, so he's right that we need to pay attention to it. And if we see rates approaching 5%, then I feel like we're in a position that yes, in fact, and indeed, the bond market's concerned about inflation. And really, I think it was some of the previous speakers from Davos talking about tariffs, because I think that's the wild card. That's really the unknown. And if we see tariffs that are restrictive and inflationary, it's going to cause a problem for all of us, because the headwinds would be a Fed not cutting rates, a Fed talking about rate hikes. And the only time that would come into the conversation, Frank, the only time that would play is if we see inflation really returning into the economy here.
Kevin, I want to get to your word of the day. It is history. Why is that important as we look at Trump 2.0?
I mean, we couldn't have a better setup. You know, history doesn't always repeat itself, but it often rhymes. And I think about tariffs being the same story that we had back in 2017. How is this going to affect trade policy? And ultimately, how is it going to affect the U.S. economy and inflation? So following up on our previous conversation, if tariffs are inflationary, that's problematic. And to Mr. Fink's point, we'll probably see that in the bond market long before we see that in the equity markets.
All right, you also have a pick for us today. What is your pick and why?
Well, I like to be contrarian, Frank. I like to buy things that people are hating on. So we added to Apple this week. Apple was trading around $260 a share at Christmas time. It's come down 15% to $220. I'm not suggesting we're calling the absolute bottom by any means, but there's reasons down here why this metric looks a lot better. Obvious reasons with the eyeball test, it's cheaper, but there are things going on at Apple beyond the iPhone 16 and 17 super cycles that still make this an incredible utility. The service model is massively profitable, and the share buybacks, which we dismiss a lot as something that's just sort of a taken for granted thing, $110 billion of share buybacks is relevant, and it helps earnings per share for 2025 and into 2026. So we bought this in DIVO, D-I-V-O, our dividend strategy again. And interestingly, it's also in our growth strategy. So one of the few names we have in both, Frank.